It's your home today on Canadian Mortgage Weekly. This is episode 123 for February 16th, 2023. My name is Joe Bladek. I'm a mortgage broker, and I'll be talking about 3 different ways to refinance your home. I know that a lot of people look at refinancing these days. This is refinance month for me on my Facebook page and what I've been putting videos out about. Last week, we talked about some pros and cons of refinancing. So this week, we're talking about 3 different ways to refinance your home. And with that, there are very specific things you can do to refinance your home properly. And one of those things is just to pick the right way of accessing your equity. A lot of the times, my clients actually will have a hard time accessing their equity properly. They'll find that when they're accessing their equity, they'll meet with the bank, and the bank will say, well, of course, we can just replace your mortgage with a new mortgage at today's rates. But you know what? It's going to happen. You're going to lose that good rate that you have today, whether it's 1% or 2%, possibly 3%, because rates are actually a lot higher right now. And of course, it's in the bank's best interest to get you to give up that mortgage at 1%, 2%, or 3% to take a new mortgage at the current 4% or 5%, 6%, even 7% with some B lenders we're seeing today. So with that, that's not sometimes the best option for all my clients. Sometimes their maturity date could be maybe a year or 16, 17 months away typically. So replacing your mortgage with a new higher rate mortgage today could put you in a bad situation because you're going to lock in for a high rate for another long period of time and not be able to pay down your principal as effectively and have a higher payment for these next 16, 17 months before your maturity date. A lot of times it's actually better to look at one of the other 2 options that I'm going to present here today. Obviously, one of the first ways to refinance your home is to replace your current mortgage with a new one. The second way, which is a lot of ways that actually work out better for the clients instead of replacing your current mortgage and giving up your rate, would actually to be getting a HELOC or home equity line of credit. With that, the rates are obviously higher right now than what your mortgage may be at, whether it's 2% or 3%. But if your maturity date is 1 or 2 years away, take a HELOC for the balance that you need, and follow me here. And then when your mortgage comes up for maturity, then you refinance everything together. One of the benefits that you will see by doing this is you'll be able to actually keep your current interest rate and pay less per month on the current mortgage you have and only pay the higher interest rate on the money that you're going to borrow and that you need. So whether it is you're doing renovations or planning a trip, if you're doing that sort of thing, or you need to pay off Canada Revenue Agency, or you have a consumer proposal you need to pay off, or maybe your property taxes are in arrears, you don't have to refinance your entire mortgage and give up that good rate to pay that off. You can take a home equity line of credit, that's a prime plus 0.2% or prime plus 0.5, whatever your credit qualifies you for, and just have that until maturity. And then we combine the 2 balances together at your maturity date. Then you're not paying a penalty to replace your first mortgage right now. You're not paying the higher rate on all the money. You're only paying higher rate on the money you're borrowing extra. And it's just sometimes a better overall solution. What's another way that we can do this? Maybe a home equity line of credit is not for you. One of the things that a lot of my clients don't like home equity lines of credit for is that actually in the fine print, we see that home equity lines of credit are demand loans. Demand loans are loans that if the bank sees fit, they can contact you and ask that you repay this line of credit within 30 days. We don't see this a lot in Canada, but it did happen a lot in the United States during the 2008-2009 financial crisis. Now, with that in mind, it's important to make sure that if you are taking a home equity line of credit, and this does happen, that you have backup means to be able to pay this off. If you don't, a lot of times clients do need to sell. And that's definitely not something you want to do right now in this market. House prices have dropped considerably, and they may drop further. So what's another way of going ahead with refinancing and taking home equity out of your home? Well, a lot of mortgage companies, including probably your own mortgage company right now, they may offer you another segmented mortgage. So you have your first mortgage, say it's $200,000 or $300,000 at 2%, for example. They will want to sell you a new mortgage at 5% today all day long. But what a lot of my clients don't realize is that that same lender in their back pocket may have a segmented mortgage that they can register behind the first mortgage for the money you need. Say if you only need $30,000 or $40,000 because you've fallen behind on property taxes, or need to invest in a business, or need to pay off your high interest credit card debt. Sometimes it's better to borrow at 30 or 40,000 at the current rates, which is 4 or 5% right now, and keeping your 2% mortgage intact rather than redoing the whole mortgage. Not all lenders and banks offer this option. So definitely it's a good opportunity to talk to a mortgage professional like myself. I've been in the business now. This is my 13th year, and I can definitely help you with the policies that each lender has and the products that each lender has to get you set up on the right foot with being able to get your mortgage done correctly. So going over the 3 different ways you can refinance your mortgage are: 1, replace your mortgage with a completely new mortgage. This would essentially wipe out your current interest rate. You would need to pay a penalty and replace it with a new mortgage. A lot of the times, clients are able to incorporate the penalty into the new mortgage balance, so you don't see it. Second option would be to take a home equity line of credit for the money you need. Perhaps you don't need it today, but you will need it soon. And then that way, a home equity line of credit is good because you're not paying interest on the full amount right away. You're actually paying interest only on the amount that you need. Or 3, take a segmented mortgage home equity loan behind your first mortgage. This can sometimes be at the same or slightly higher interest rate than your first mortgage. Today's market actually be higher because of the market conditions we are in, but that's keeping your current rates on the rest of your mortgage. And then at your maturity date, we actually combine all the balances together. And at that point only, you're paying that higher amount. So those are 3 different ways to refinance your mortgage. Let's talk about some of the other items going on in the market today. We have current average mortgage payments. So 5-year fixed rates did go up this week. Unfortunately, we saw the 5-year fixed rate jump from 4.69 to 4.79. So I've reflected the monthly payment for a $475,000 mortgage at $2,706.11. And the biweekly payment at $1,247.65. So slightly higher. It's about $10 more biweekly. And a lot of reasons for this, actually. The bond yield has been going up, which I'll illustrate to you soon. And a lot of people are starting to move. A lot of people are starting to see, well, weather's getting warm. We've waited. Rates are where they are at. They're not really going to go anywhere else. So there's a lot of pent-up demand right now from folks that have been waiting on the sidelines. And they're making moves now. Also, refinance illustration up there for you. That really hasn't changed. Refinance rates are still at 5.24%. The 5-year bond yield. Wow, let's take a look at this here. Do you see that? The 5-year bond yield has been going up, as you can see. This has been a recent uptick in the last 1.5 weeks, actually, as you can see. Really high. And what I'm noticing is that banks are following with their fixed rates. When the fixed rates were reflecting here, they were about 0.5% lower than what they are today. So, a lot of banks are going to be raising their fixed rates. I'm getting notifications today. Get your files in before fixed rates go up further. So I don't know if this is going to be a trend going forward, but It'll be depending on if we are going to break this line here, right? To see if it goes up any further. If it breaks that, then it could. Obviously, we have a Bank of Canada decision coming up in about 3 weeks. And usually the bond yield does spike before the Bank of Canada interest rate announcement. Inflation numbers are out for the United States, but not for Canada yet. Canada, we still have numbers for December. They're pretty old at this point. We're sitting at 6.3% for December. Waiting to see what happens for January. Now, if we look at January numbers for United States inflation, it's now at 6.4%. The month before was 6.5%, and the month prior to that, 7.1%. So you can see the graph illustrates that declining inflation rate. However, inflation is still very high. And with this small decline in inflation, that could have precipitated the bond markets reacting the way they did. CDOR rate. It's flatlining. It's been flatlining now for a few episodes. I do these episodes every week for my customers and clients. This is Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast. And as you see, with the CDOR rate stagnating the way it has at 4.99%, the variance to prime is still sitting at 1.71%. We are noticing that it stopped going up a few weeks ago. We'll have to see what happens with this CDOR rate come the prime rate announcement on March 8th. Prime rate right now sitting at 6.7%. That's as of today, should say as of February 16th. 6.7% is a very high prime rate, although it's only been high now for about 12 months since the super low prime rates. I'm seeing lenders say now that prime rates should start coming down at the end of the year, 2023. Both National Bank and TD Bank are now calling for prime rate reductions at the end of 2023, which helps anyone in a variable rate mortgage because, there is some pain that we are all experiencing, us variable rate holders, until the prime rate starts dropping again. And with that, the prime rate announcement is on March the 8th, 2023 at 10 a.m. I'll be doing a special episode here of Canadian Mortgage Weekly, Canada's only video mortgage weekly news podcast. On March the 8th, we'll be starting at 9:45 a.m. with a pre-rate show with all the news that has led up to the moment, with a prediction and seeing what happens. The last rate increase was the last rate announcement, and that was a 25 basis point increase. Currently, the overnight rate for the Bank of Canada sits at 4.5%. National average house price. We don't have an update today for January. However, in December, we did see the national average house price go down 1%. Really, the national average house price has not been moving since August. Since August, we've seen increases and decreases of about 1 to 3% either direction. What does that tell me? It means that there's demand from the one side pushing the house price up, but can't go up really much more than where it is now because rates are making it very hard to qualify. Let me give you guys a story. I have a client, government worker, wants to buy a house on her own, has no family help, makes good money, has no credit card debt, and can't afford a home. Not even the cheapest home. Why? Well, these days you need pretty much 3 average incomes or 2 high incomes to buy the average home in Canada. That is quite crazy. So how do people do it? Well, a lot of clients that are buying their first home, like my client here, the story I'm telling you about, she works in the government making a good wage, no credit card debt, can't afford a home. She'll need to get a cosigner. And even if that cosigner comes on board, that's only going to be 2 incomes. And that still may not be enough for her to buy a home in Canada. You are seeing now 3 incomes are required to buy the average home in Canada. And with those incomes, we need to have very little debt on those profiles to be able to actually make it worthwhile for that person to get into a house in today's market. So the average national house price, I'll have the January numbers for us next week on Thursday. In the meantime, thanks for watching. episode 123 of Canadian Mortgage Weekly, Canada's only video mortgage news podcast. I am celebrating 350 episodes this week. So if any one of you wants to send me a message, that'd be great. If you're looking at getting a mortgage or want to meet with a broker, please contact me by scheduling an appointment in the video description link below, and we'll see you